let us take the first problem. A Limited has been conducting its business activities in backward areas of the country. Due to higher operating costs in such regions, it has collectively incurred huge losses in the previous years. As per a scheme of government announced in March 2011, the company will be partially compensated for the losses incurred by it to the extent of 10 crores, which will be received in October 2011. The compensation being paid by the government meets the definition of government grant as per Ind AS 20. Assume that no other conditions are to be fulfilled by the company to receive the compensation. When should the grant be recognized in the statement of P&L? Discuss in the light of the relevant Ind AS. So the relevant Ind AS is already given in the question, that is Ind AS 20. The company was incurring losses in the previous year, so the government announced a scheme through which the company will be able to get a compensation of 10 crores. The scheme was announced in March, but the grant will be received in October 2011 only. According to the question, the compensation being paid by government meets the definition of government grant. And there are no other conditions to be fulfilled by the company to receive the compensation. So the question is, when the grant be recognized in the statement of P&L? Now, whether the grant will be recognized in statement of P&L, that we don't have to worry, because the question itself says, when should the grant be recognized in statement of P&L? That means it should be recognized in statement of P&L. The question is when. Whether it is in the year 2010-11, in which the government has announced the scheme, or in the year in which it will receive, that is 2011-12. That is a basic question. According to the question, no other conditions are to be fulfilled. All the conditions required to be satisfied is fulfilled. So the company is surely going to get the compensation. So, according to Ind AS 20, when this grant should be recognized? Is it in the year 2010-11, the year in which the scheme was announced, or in the year 11-12, when the company actually received the grant? Which year? That is a question. Before I go to the answer, can anybody of you tell me what would be the answer? Just a guess. Will it be in 10-11 or 11-12? Any guesses you want to make, or maybe by proper application of standard also, you might be able to arrive at the correct solution. Can anybody share your answer with me in the chat box, or you can unmute and speak to me at your convenience? The answer is, we're expecting is very easy. Is it in 10-11 or 11-12? That is the question. Can anybody interact, provide the answer?
Good afternoon, sir.
Good afternoon, Ankita.
Yes, sir. Sir, I feel it is based on accrual concept, since it, as per Ind AS 20, it is satisfying all the conditions. It should be recognized in 10-11 itself, but it can be deferred. Yes, sir.
Okay.
It can be 10-11 itself, because on accrual concept, since it is already recognizing 10-11 is what I think.
Okay, thank you, Ankita,
Thank
for the answer.
you, sir.
And Gerald
Thanks,
also
sir.
has given an answer. 2000. He has simply said 2011. Is it 2010-11 or 11-12? I'm not very sure. Anyway, thanks for responding. This is what will make the session more interesting, friends. Thank you for your interaction. Let us see what is the actual solution. According to paragraph 7 of Ind AS 20, see, whether you know the respective paragraph or not, you don't have to bother, friends. But we surely know this is a problem or a question based on Ind AS 20. So whether you know the correct paragraph or not, don't be worried. At least you mention as per AS 20. Government grants, including non-monetary grants, shall not be recognized until there is a reasonable assurance. That means if there is a reasonable assurance, then the grant can be recognized. But it should not be recognized until there is a reasonable assurance that the entity will comply with the conditions attached to them and the grant will be received. This is what Ind AS 20 tells us. That means, in other words, or looking at it positively, if there is a reasonable assurance that the entity will comply with the conditions and the grants will be received, then in the year in which the conditions have been complied with and the year in which they might expect to receive it, in that year, the government grant shall be recognized. So that is the conclusion we come to. Further, paragraphs 20 and 22 state that a government grant that becomes receivable as compensation for expense or loss already incurred, or for the purpose of giving immediate financial support, shall be recognized in P&L of the period in which it becomes receivable. So, very, very clearly, as Ankita said, it should be recognized in the P&L in the year in which it becomes receivable. As you know, all companies have to follow accrual-based accounting. So therefore, we need not wait till the grant is actually received. Once the grant becomes receivable, when will you conclude it becomes receivable? There should be a reasonable assurance that the entity will comply with the conditions attached to them, and there is 100% certain that the grants will be received. According to the question, all condition relating grant has been fulfilled. So there is no question of seeing whether the entity will comply. The entity has already complied. When there are no other conditions to be attached, then we can say there is reasonable assurance that the grant will be received. And according to paragraph 20 and 22 of Ind AS 20, when the grant becomes receivable, it shall be recognized in the P&L in the period in which it becomes receivable. So in which period or in which year the grant has become receivable? Is it in the year 10-11 or 11-12? Such a grant recognized in the profit or loss or the period in which it is receivable, disclosure to ensure that its effect is clearly understood. So this is what is given in the standard. Now apply that to the given situation in the problem. In the above case, as on 31st March 2011, A has become entitled to receive the grant, even though they may receive the compensation in the month of October. They have become entitled as on 31st March 2011 itself. So therefore, based on the standard and the information given in the question, the company should recognize the compensation receivable as a government grant in the profit or loss for the period in which it became receivable, that is in the year 2010-11 itself. But of course, you have to provide adequate disclosure to ensure that its effect is clearly understood. So therefore, as Ankita said, this is the correct answer. Grants can be recognized on receivable accrual basis provided all conditions are satisfied and there is reasonable assurance that the grant will be received. So the problem tells all conditions satisfied. Therefore, the grant should be recognized as income in the P&L in the year 2010-11 because it became receivable in that year. Then whenever the grant is received in October 2011, the receivable asset can be knocked off and cash balance will increase. So that is how we will have to present an answer for this question. 4 marks or 5 marks you will get, friends. If you're able to finish this off in 10 minutes maximum, it's worth doing it in the examination. Before I go to the next question, friends, if you have any questions, please ask me. I'll then go forward. You can put your questions in the chat panel if there are any. Otherwise, you can say, yes, sir, we can go forward, we can proceed. So let me take it forward. Question number 2. This question is based on accounting estimate in accordance with Ind AS 8. Let us read the problem carefully, friends. In 2013-14, after the entity's 31st March 13 annual financial statement were approved for issue, a latent defect in the composition of a new product manufactured by entity was discovered. They say latent defect. That means it is not easy to detect the defect. It requires some efforts. So that's why it's called latent defect. It's not very obvious. A defect that could not be discovered by reasonable or customary inspection. So after the statements are approved, they detected a defect, latent defect in the composition of the new product manufactured by them. And because of that defect, the entity incurred rupees 1 lakh in unanticipated cost for fulfilling its warranty obligation respect of sales made before 31st March 2013. An additional 20,000 was incurred to rectify the latent defect in products during 2013-14 before the defect was detected and the production process rectified. Rupees 5,000 of which relates to items of inventory on 31st March 13. So 1 lakh is the unanticipated cost for warranty obligation. 20,000 incurred to rectify the defect. So total lakh and 20,000 rupees additional cost was incurred. In the 20,000, 5,000 relates to items of inventory on 31st March 2013. The defective inventory was reported at cost of 15,000 in the year 2012-13 finance statements, when its selling price less cost to complete and sell was estimated at rupees 18,000 rupees. So therefore, they have taken the lower of that 15,000 rupees. 15,000 is the cost. Selling price less cost to disposal is 18,000. So they have considered the defective inventory at 15,000 rupees. Okay, right. Now, what is the question? The accounting estimates made in preparing the 31st March 13 financial statements were appropriately made using all reliable information that the entity could reasonably be expected to have been obtained and taken into account in the preparation and presentation of finance statement. That means the accounting estimate made by the company was not done arbitrarily. It was based on reliable information which the entity could have expect to achieve or receive. Based on that only, the accounting estimate was done. Okay, that means it is not just random number they have taken and they made an estimate. Analyze the above situation in accordance with the relevant Indian accounting standard. So what is the relevant Indian accounting standard here? Friends, as you know, this standard talks about accounting estimates. Estimates made in an earlier year based on the reliable information available at that point of time and which the entity could reasonably expected to obtain. Okay, so whether the estimate made was right or wrong will be known only when the situation changes. Maybe you have to change the provision for the estimate made earlier. Now, what is the relevant Ind AS? That is the most important one. Is it Ind AS 8 or Ind AS 10? Is it change in accounting estimate or it is an error? That is the first point you should conclude, and depending on that, you have to present your answer. Solution. So before I go to the solution, can you guess anything? Is it a change in accounting estimate, Ind AS 8, or rectification of error, Ind AS 10? Which do you think is a relevant Ind AS applicable to this question? You can present your answers in chat also, or you can unmute and talk to me at your convenience. Yes, Ankita, you want to say something?
I feel it might be all the estimates correctly based on financial statements. If the inventory amount is material, it will be a more of a rectification of error than as a change in accounting policy.
No, actually, Ankita, there is no accounting policy involved here. It's only an accounting estimate.
Sorry, it's accounting estimate.
Okay, let us see whether you are right. So according to Ankita, it seems to be an error which you have to rectify. Okay, let us see whether that is the appropriate answer. Friends, Ind AS 8 is to be applied in applying accounting policies, accounting for changes in accounting policies, changes in accounting estimate, and correction of prior period errors. Now, whether it is an error or not, that's what we have to find out. What is a change in accounting estimate? It's an adjustment of the carrying amount of an asset or liability, or the amount of the periodic consumption of an asset. This change is an outcome of the assessment of the present status and expected future benefits and obligation associated with assets and liabilities. A change in accounting estimate results from new information or new developments, and accordingly are not corrections of errors. Actually, what is an error? Some mistake we had committed when we prepared the financial statement of the last year. It could be an omission, it could be some errors which you had committed. It's not something which is deliberate. And you have noticed that error subsequently when you are preparing the financial statements of the subsequent years. Only that situation is known as a prior period error. Whereas you made an accounting estimate in an earlier year based on the relevant information available at that point of time. And subsequently, the situations have changed. You have got some new information. Based on that, if you have to make a change in accounting estimate, it cannot be recognized as an error or a prior period item. It will be recognized as a change in accounting estimates only. Okay. If there is a change in accounting estimate, what shall be done? It shall be recognized prospectively. A change in accounting policy may have a retrospective effect, but a change in accounting estimate shall always be done prospectively by including that in the P&L. In the period of change, if the change affects that period only, or the period of change and future periods, the changes affects both. Suppose there is a change in depreciation, it will affect not only that particular period in which you have changed the method, it will affect the subsequent periods also. Whereas here it is a change in accounting estimate based on a warranty obligation. And it's a latent defect. Later only you found out that the defect is there. So this change will have an effect on this period only, not the future periods. So we have to find out, number one, whether we have to make a change in accounting estimate or to rectify an error. Rectification ever results in a prior period item. Change in estimate, you have to recognize prospectively in the P&L in the year of change, if it affects that year only. If it affect subsequent years also, you have to include it in the P&L of that year and the future periods also. Therefore, again, friends, very clearly we say what is a prior period error? Omissions, misstatements in the entity's finance statement for one or more prior periods from a failure to use or misuse of a reliable information that was available when the statements for those periods were approved for issue and could reasonably be expected to have been obtained and taken into account in the preparation and presentation of financial statements. It's very clearly given in the question. When the financial statements were approved for issue, this information was not available. They have acquired all the reliable information which they could, which they can obtain. All the necessary caution they have taken. So therefore, we cannot conclude this as a prior period error or an item which to be rectified, but as a change in accounting estimate only. Errors could be mathematical errors, mistakes in applying policies, oversights, misrepresentation of facts, or fraud. So, how would you deal with the given situation? Very, very clearly it is the defect was neither known or reasonably possible to detect on 31st March or before the statements were approved for issue. So the understatement of the warranty provision of 1 lakh and the overstatement of inventory by rupees 2000 are not prior period errors. We have considered all the reliable information at disposal, whatever information that we could expect to obtain, we have obtained. Based on that only we have made a provision. So we have not made any understatement of warranty provision earlier because of an error or a mistake. So, and similarly, there is overstatement of inventory also. So we cannot consider these as prior period errors. But since there is a mistake, we will have to take care of that and account it subsequently. So therefore, the effects of the latent defect that relate to entities' financial position on 31st March 13 are to be regarded as change in accounting estimates. So why? Because they have taken all reliable information that the entity could reasonably be expected to obtain, and we have taken that into account in the preparation and presentation of financial statements. So the additional cost expensed or incurred will be expensed, will be charged to P&L in calculating the profit loss for the year 2003-4. It will not be represented or disclosed as a prior period item. But where there is a change in accounting estimate, because of that, how the profits of this current year were affected has to be properly disclosed in the notes to accounts. Now, how inventory was valued 2000 more? That's what we want to know, is it not? As we know, friends, inventory is measured to the lower of cost and fair value, less cost to complete and sell. 18,000 originally estimated minus 5,000 cost to rectify the latent defect. That is a further cost we'll have to incur. But at that time, the defect was not visible. So we considered only 18,000 rupees. But later we came to understand, in order to rectify the latent defect, another 5,000 will be incurred. So therefore, the fair value less cost to complete and sell will be 13,000 only, not 18,000, whereas the cost is 15,000. Therefore, the inventory should be measured at 13. It is overvalued by 15,000 rupees. So the excess valuation of inventory of 2,000 will also would have had an impact in the P&L of the last year. Yes, I find. Yeah, Mr. Gerald says it's fine.
Yes, sir. Thank you.
Okay, ma. Now let's take up the next question. Next question is based on Ind AS 10. I will not hold anything, no suspense. I will tell you directly. This problem is based on Ind AS 10. That means there were some errors or events before the period that has to be taken into consideration. Let's see the problem. During 14-15, Cheery Limited discovered that some products that had been sold during 13-14 were incorrectly included in inventory on 31st March 14 at rupees 6,500. So they have already sold these goods in the year 2013-14, but they wrongly included that in inventory as on 31st March 14. But that was discovered only in the year 14-15. So Cheery Limited's accounting records for 14-15 shows sales of 104,000, cost of goods sold 86,500, including 6,500 for error in the opening inventory, and income taxes of 5,250. So when last year's closing stock was overstated by 6,500, automatically it will result in increase in opening inventory for this year that got included in the cost of goods sold of this year. So sales of 104,000, cost of goods sold 86,500, including that error. Income tax of 5,250. That is what accounting records of this year shows. In 2013-14, the company reported like this. Sales is 73,500. Cost of goods sold 53,500. So the profit is 20,000. Income tax 6,000. Profit 14,000. The basic and diluted EPS is 2.8. Both are same. Probably there are no potential equity shares. So the basic as well as diluted EPS both are 2.8. So the profit is 14,000. If EPS is 2.8, easily you can find out how many number of shares were there. But anyway, that information is also given in the question. Later we will see that. The 2013-14 opening retained earnings was 20,000. Closing retained earnings was 34,000. Very simple. Opening balance 20. Add the profit for this year, 14,000. Therefore, closing balance is 34,000. And the income tax rate was 30% for both years 14-15 and 13-14. No other income or expenses were there. Cheery Limited had 50,000 rupees, 5,000 shares of 10 each of share capital throughout. No other components of equity except for retained earnings. So that is why the basic and diluted EPS was 2.8, 14,000 profit, 50,000 shares and so on. Based on the easily find what is the diluted and basic EPS per share. Show how the above will be treated or accounted in Cheery Limited's statement of P&L, statement of changes in equity, and in notes wherever required for current period and earlier period or periods as per the relevant Ind AS. So again, the relevant Ind AS is what? That's what we have to find out here. Okay. Now, friends, please clearly see. What is given in the question is for the year 2014-15, sales was 104. There is no change in that. Cost of goods sold 86,500, but that included opening error of inventory 65. So eliminated. So the correct cost of goods sold is 80,000 only. Whereas for the last year 13-14, the statements have already been prepared. But now when we present the comparative, we have to restate it by rectifying the errors. So last year's sales was 73,500. Last year cost of goods sold was 53,500 by eliminating that 65. So we have to add it back to get the cost of goods sold as 60,000 rupees. So what has been sold has been taken as inventory. So you have to reduce in inventory. What will happen? Cost of goods sold will increase. So in the year 14-15, cost of goods sold will decrease by 6,500. In the restated P&L of 13-14, cost of goods sold will increase by 6,500. So therefore, the correct profit for this year is 24,000 and the restated profit for last year is 13,500. Apply 30% on that. That will be the income tax for this year and the next year. Therefore, the profit 24,000 minus 7 to 16,800, 13,500 minus 4,450 is 9,450. Hence, the basic and diluted EPS will also change. 16,800 divided by 5,000 shares, you will get 3.36 as EPS. 9,450 divided by 5,000 shares, that will be the correct or restated EPS for the last year. So I hope you understand. The inventory adjustment is done in the cost of goods sold. This year, reduce 65. Last year, add 65. Automatically, every other item will change. Now coming to the statement of changes in equity. Share capital, no change. From the beginning to the end, no change. But what about retained earnings? The opening balance on retained earnings of 2013 was 20,000 rupees. Add the profit for the last year, it became 29,450. Again, add the profit for the current year, it becomes 46,250. So therefore, on 31st March 2015, the equity is 96,250, of which share capital is 50,000 and other equity is 46,250. Now, very importantly, we have to give the notes. That is more important. Certain products were sold in 2013-14, wrongly taken in inventory, 6,500. Once it is sold, it will be shown as sales, not an inventory, 6,500. So the closing inventory was overvalued in that year. Now we have to rectify or to restate the finance statement of the year 2013-14 to correct this error. And the effect of this will be adjusted in the retained earnings only. So what is the effect of the restatement? You can see here. Increase in cost of goods sold, 6,500. Because of that, decrease in income tax expenses, 1,950, 30% of that, resulting in a decrease of profit, 4,550. So decrease in basic and diluted EPS is 0.91. So divide this by 5,000, get 0.91. The decrease in inventory will be 6,500. Decrease in income tax payable is 1,950. Therefore, decrease in equity is 4. So this will be the balance sheet. The balance sheet, inventory reduces by 6,500. Liability income tax decreases by 1,950. And equity decreases by 4,550. Whereas in the P&L, increase in cost of goods sold results in decrease in profit and decrease in income tax expense. And ultimately, the basic and diluted EPS also will decrease by 0.91 rupees. So is it not a very easy one problem, friends? 6 marks you will get in the exam, for which you can spend around 10 to 12 minutes in the examination. Are you clear? Or you have any queries, please ask me. Then I will go forward to the next question. Question number 4. Friends, this question is based on share-based payments. Accounting standard number 102. Let us see the question first. Company P is a holding company for company B. a group share-based payment is being organized in which the parent issues its own equity shares to the employees of company B. So the holding company is issuing a share-based payment to the employees of the subsidiary company. The details are number of employees of company B 100. Each employee granted 25 shares at the rate of 87, whereas the face value is 10 per share. The vesting condition is immediate. No need to check for any condition. As and when the grant is given, immediately the options will vest on them and the employees can exercise it. Company B will issue the shares. Pass journal entries in the books of company P and company B. So what is the entry in the books of the holding or the parent company? An entry in the books of the subsidiary company. See, on the one side, for company P, parent company, it is issue of equity shares to employees of the subsidiary company. That means they are incurring a cost in relation to employees of the subsidiary company, but the cost is satisfied or discharged by issuing equity shares of their company. For what value? 100 employees, each will get 25 shares at the rate of 87 rupees per share. So the total cost incurred by company P will be 100 into 25 into 87. That works out to 2,17,500. But since it is satisfied by issue of shares, face value 10, 2,500 into 10 will go to capital. Balance 77 rupees per share will be credited to security premium. For the parent company, it is an addition or accretion to the cost of investment in subsidiary. On the other side, company B is receiving a benefit. Company B's employees are receiving a benefit from company P. It's as if the company P has made a capital contribution. And it is a benefit, employee benefit expense to be recognized in the books of company B for the total amount of 2,17,500. So friends, if there is clarity about this, then accounting becomes very, very simple. Okay, let us see what is the answer for this question. So in the books of the parent, total cost is 2,17,500. That is 25 shares into 100 employees into 87. 2,17,500. That will be debited to investment in company B. That will increase the cost of investment in subsidiary. So debit the investment in company B. How that is satisfied? By issue of shares. Face value of share is 10. 25 shares for 100 employees. So 2,500 shares. So capital will be credited with 25. Premium, that is excess over the face value, 77 rupees per share, will be credited to securities premium, which is 190 to 500. This is the journal entry you have to make in the books of the parent company. Now in the books of the subsidiary, it's a capital contributed by the parent. So you have to credit the capital contribution from parent P and you have to debit the employee benefit expense. See, had company B itself offered the shares to their employee by issue of shares, they would have debited employee benefit expense, they would have credited the capital. But here, company B's employees are getting the benefit. So it should be recognized as a cost in the books of company B. But the shares are issued by parent company. Therefore, we should record it as a capital contribution from parent P. So in the books of the subsidiary, employee benefit expense account debit to capital contribution from parent P. That is how we have to record this, friends. Is it not very easy to understand? Any questions are there, friends? Again, 4 or 5 marks can be given for this problem. So the first 4 problems, grants, accounting estimate, errors, share-based payment, all these will carry around 5 marks only in the examination. We have 2 more problems, problems number 5 and 6. One on share-based payment, that is Ind AS 1 or 2. The other one on fair value measurement. That could fetch you around 8 marks in the examination. Question number 5. But that will be slightly difficult one. It may take some time. Anyway, first let us read the question and then we'll go forward. On 1st April 2011, the fair value of an option was rupees 1.2. The fair value increased to 1.3 as on 31st March 12. But due to challenging business condition, the fair value declined thereafter. So from April 2011 to March 2012, increase in fair value. But suddenly there was some challenging business condition. Profits have come down, it seems. Therefore, the fair value declined. 6 months later, that is in September 2012, when the fair value of an option was rupees 0.90 paise, the directors repriced the option and this caused the fair value to increase to 1.05. So original fair value 1.2 increased to 1.3 in 1 year. Later, because of difficult business condition, fair value got decreased. On account of the directors repriced the option price, so it resulted in an increase in the fair value. Right. Trading conditions improved in the second half of the year, and by 31st March 2013, the fair value of an option was rupees 1.25. So again, in the second half, there is an increase in the fair value. It became 1.25. So the fair value keeps on changing, going up and down, and directors also reprice the option price. The company decided that the additional cost incurred due to repricing the options on September 30 should be spread over the remaining vesting period from September 30 to March 14. That means whatever additional cost will be incurred by the company on account of change in fair value and the repricing of option, that should be absorbed over a period of 1.5 years. See, September 2012 to 31st March 13. In 1.5 years, the additional cost incurred has to be absorbed by the company. That is what they have decided. See, whether they decide like that or not, it has to be done like that only, because that is what is the guidance given by the accounting standard number 102. Okay. The options are due to vest on 31st March 14, provided employees remain in employment till 31st March 14. So from September 12 to March 14, the incremental fair value should be amortized. From April 1 to 31st March 14, the original value of equity instruments, the cost to be incurred on the original equity instrument should be amortized. So keep that in mind. Okay. If there's a decrease in fair value, you don't have to account for that. When the increase in fair value on account of the additional cost is incurred by the company, the additional cost is to be absorbed in the remaining period up to the date of vesting. Okay. On 1st April 2011, the directors of the company estimated that 1,800 employees would qualify for the option on 31st March 14. At the time of grant, they thought so many employees would be entitled for the option. But end of the year, the estimate was amended to 1,850 employees, further amended to 1,840 employees on 31st March 2013. So initially estimated 1,800. Maybe in 1 year, the company found that 50 more employees will become entitled. But actually on 31st March, only 1,840 employees became entitled to that. So we have to keep all these information in mind, and you are requested to suggest the suitable accounting treatment for these transactions as on 31st March 2013. So we still have one more year till the vesting period gets over. But in between, there is a change in fair value, and because of that, the options were repriced. Additional cost may be incurred by the company. How to account for the original cost based on the equity instruments granted, and how to account for the increase in the cost over the remaining vesting period. That is what we have to do, friends, in this case. It's not a complete problem right from beginning to end, but just 2 years. Within that, there is a change. How you have to measure the cost to be absorbed, how to account for that. That is what is asked in the question. So it's a very interesting question, can carry around 8 marks in the examination. Now, friends, the solution to the problem number 5. But friends, let us take a short break now because it's almost 1 hour since we started. A 10 minutes break we will take. Then we will proceed with the solution for problem number 5. After that, we can take the most important question, problem number 6 on Ind AS 113 fair value measurement. So I request you to join 10 minutes from now. Okay. Solution to problem number 5. See, what does Ind AS 102 talk about? Accounting treatment for change in fair value. If the fair value decreases, it will definitely result in an additional cost to the company. That means it is beneficial to the employee. See, according to paragraph 27 of Ind AS 102, entity should recognize effects of repricing that increases total fair value, or they are otherwise beneficial to the employee. If the repricing increases the fair value of equity instrument granted, such and such paragraph, as I told you, if you do not remember the paragraph, just leave it off. The standard requires entity to include the incremental fair value granted, that is, the difference between the fair value of the repriced equity instrument and that of the original equity instrument, both estimated as at the date of modification. So on the date of modification, you should find out what is the fair value of the repriced equity instrument, what is the fair value of original equity instrument. The difference, if any, which is beneficial to employee, should be accounted for in the measurement of the amount recognized for service received as consideration for the equity instruments granted. That is what the standard says about change in fair value leading to change in option pricing. If the repricing occurs during the vesting period, see, that is what is the case here. The repricing happened during the vesting period. The incremental fair value granted is included in the measurement of the amount recognized for service received over the period from the repricing date until the date when the repriced equity instruments vest. In other words, in this case, when the repricing was done, September 30, 2012. When is the last date for vesting? 31st March 14. So that 1.5 years period, you should recognize the additional cost incurred because of the change in price. In addition to the See, already we would be recognizing an amount based on the grant date fair value. That should continue. In addition to that, if any repricing occurs during the vesting period, then we should include the incremental fair value also in the measurement of the amount recognized for service rendered from the date on which the repricing was done till the date on which the equity instruments vest. In this example, it is from September 30, 2012 to 31st March 2014. So therefore, what is the amount to be recognized in year 1 and 2 is determined as follows. See, very easy. Initially, they had estimated that 1,800 employees will get the option. But later on 31/3/2012, this is amended to 1,850 employees. Each will get 1,000 options. At that time, the fair value is 1.20. Grant date fair value is 1.20. This will be amortized over a period of 3 years because the vesting period is 3 years. So in the first year, 1/3 will be taken. So for the first year, expense to be absorbed is 7,40,000. Up to first year, 7,40,000 only. In the second year, very careful. In the second year, what happened? There is a repricing. On account of the repricing, there is a change in fair value of the repriced equipment, repriced instrument, and the fair value of the original equity instrument. Both should be determined as on the date of modification. That should be amortized over the remaining vesting period. In addition to the original equity instruments granted. So at the end of the year 31/3/2013, 1,840 employees are expected to exercise the option. 1,000 options per employee. Fair value is 1.2. But we are in the second year. So 2/3 of that should be recognized. But already 740 recognized in the first year. That is one part. What is the second part? The increase in the fair value from 1.05 to 0.90. The difference into so many employee option, which should be absorbed over a period of 1.5 years. Now only half year should be considered. So 1,840 into 1,000 options into 1.05 minus 0.90 to be absorbed in 1.5 years. Now only half year. So multiply half year. That will be the total expense to be absorbed till the end of the second year. Of that, already 740 recognized in the first year itself. So the total expense to be absorbed is 15,64,000. If you do this calculation, you get 15,64,000, friends. 1840 into 1,000 into 1.2 into 2/3. That comes to 14,72,000. That is the amount of expense to be absorbed on the original options granted in 2 years. Keep it aside. Because of the repricing, what is the difference in price, difference in fair value? 1.05 and 90. So 1.05 minus 0.9 into 1,840 into 1,000 option, 2,76,000 for a period of 1.5 years. In that, only half year has gone by as on 31/3/13. So by 3, that comes to 92,000. So add both, the total expenditure to be absorbed in 2 years, including the expenses for the increase in fair value, is 15,64,000. Of that, already 7,40,000 has been recognized in the first year. So deducted 7,40,000. Therefore, for the second year, the total cost to be absorbed or amortized will be 8,24,000. So first year 7,40,000, second year 824. Therefore, end of the second year, cumulative expense absorbed is 15,64,000. That is how we have to get the answer for this question. Friends, if you have any question, please do not hesitate. If you have any doubts or questions in this, please ask me. I will try to explain to you if you want once again also. If you are clear, okay, we can go to the next problem. Okay, right. Question number 6. This question is based on fair value measurement in days 113. Now, whether you will get a question from this in the examination, in my opinion, there has not been many questions from the standard on a regular basis. But it's a very important, very good standard. Many questions can be asked. Since so far not many have been asked, I strongly believe that the institute may think of asking questions from this standard on a regular basis, at least from this December examination. And there is a possibility of getting some huge questions on that, which can even carry 8 marks. In fact, that is what they have just given a clue to you. Question is given in RTP. So there is a possibility either the same question or a similar question may appear in this December exam, if not at least in the May exam, very much possible. So we thought, since Institute itself has given a clue that there is a possibility of a question on this, we would like to take it and try to explain this in the live session. It's a very good question, friends. Let's take it up. Question number 6. On 1st April 17, A Limited assumes a decommissioning liability in a business combination whereby the entity is legally required to dismantle and remove an offshore oil platform, end of its useful life, estimated to be 10 years. Good. A Limited uses the expected present value technique to measure the fair value of the decommissioning liability. I hope you're able to understand they're acquiring a business. In connection with the acquisition of business, they have assumed a decommissioning liability legally. So it's a legal obligation is there. Where there is a legal obligation, according to Ind AS 37, a company is supposed to determine the present value of the legal obligation and should make a provision for that, is it not? So therefore, there is no doubt that this company has to recognize the decommissioning liability by discounting the estimated expenditure after 10 years to its present value as of today. So they're using the present value technique to measure the fair value of the decommissioning liability. If A Limited was contractually allowed to transfer its decommissioning liability to a market participant, if that means what? There is a possibility that A Limited can transfer this decommissioning liability to another person, a market participant, then that person will use the following inputs, probability weighted as appropriate when estimating the price it would expect to receive. So what's the benefit they will get? Accordingly, they would want to accept the liability. They would consider all these inputs for the purpose of takeover of the decommissioning liability. What are the points? Number 1, labor cost developed on the basis of current marketplace wages adjusted for expectation of future wage increases, required to hire contractors to dismantle and remove offshore oil platforms. A Limited assigns probability assessment based on A Limited experience with fulfilling obligation type, its knowledge of the market, to a range of cash flow estimates as follows. 50,000 rupees is the labor cost estimated, probability of 25%, 62,500 expenditure, 50% chance, 87,500 chance of 25%. So this will be the labor cost. So what will be the expected labor cost? We have to find out based on the probability weighted average. The cash flows and different probability ranges are given here. This will be helpful to determine the total expected labor cost to accept the decommissioning liability. Number 2, A Limited estimates allocated overhead and equipment operating cost to be 80% of the expected labor costs, inconsistent with the cost structure of the market participants. See, once you determine the expected labor cost, 80% of that will be the overhead and equipment operating cost. That also should be considered for accepting the decommissioning liability. A Limited estimate the compensation that a market participant would require for undertaking activity for assuming the risk associated with the obligation to dismantle and remove the asset as follows. So they would expect certain compensation for accepting this risk. What are they? A third-party contractor typically adds 20% markup on labor and allocated internal costs to provide a profit margin on the job. It means in addition to labor cost, in addition to allocated overheads, 20% markup should be added because that only will enable them to reduce their risk in relation to the dismantling and removing of the asset. A Limited estimates 5% premium of the expected cash flows, including the effect of inflation for uncertainty inherent in locking in today price for a project that will not occur for 10 years. So in addition to the 20% markup, additional 5% may be expected, may be added to the expected cash flows to adjust the effect of inflation. So that also will be considered as part of the cost to be incurred to take over the decommissioning liability. Entity A assumes a rate of inflation of 4% over the 10-year period on the base of the available market. So increase in prices, that also should be taken because we are recognizing the cost as of today. But the cost is going to be incurred after a so many year period. So what is the inflation rate? They say it is 4% per annum. Inflation of 4% per annum over the 10-year period. The risk-free rate of interest for a 10-year maturity on 1st April 17 is 5%. A Limited adjusts that rate by 3.5% to reflect its risk of non-performance. That's a risk that it will not fulfill the obligation, including credit risk. That means instead of taking over this liability, they put that money in a 10-year bond, they'll get 5%. If they do not perform the obligation, they will have to incur additional 3.5%. That means what is the expected return? They are looking at this is 8.5%. Is it not? A Limited concludes that its assumptions will be used by market participant. In addition, A Limited does not adjust fair value measurement for the existence of restriction, preventing it from transferring the liability. So no need to make an adjustment for fair value. So without adjusting for fair value, you find out what could be the fair value of the decommissioning liability based on the inputs given by A Limited. That is a question, friends. So it's a very good question. Sometimes it may be very difficult to understand certain things. Premium of 5% is there, inflation rate of 10%, risk-free rate of 5% plus 3.5% reduce the risk. All that to be correctly analyzed, understood, and applied appropriately to measure the fair value of decommissioning liability, friends. Because that will give an idea for what value the decommissioning liability could be taken up. Clear? Let us see the answer, friends. This is the answer, but before that, we would like to calculate the expected cash flow relating to labor cost. First page, you will be showing the total fair value of the decommissioning liability, but for that purpose, you need to prepare a working note to determine what could be the expected cash flows relating to the labor cost. According to the information given in the problem, the cash flow will be 50,000 subject to 25% chance. So multiply 62,500, 50% is 31,250. 8,750, 25% chance, 21,875. So the expected cash flow will be 65,625. So labor cost is expected to be 65,625. Just multiply the cash flow by the probability weighted average. That's it. Simple. Now you see here, friends, expected labor cost will be 65,625. Good. The allocated overhead equipment cost as given in the question will be 80% of the labor cost. So 80% of this 52,500. I believe the numbers are correct. Don't have to check the numbers, friends. So what is the total cost? 65,625 plus 52,500. That's the total cost. On that, contractor's markup of 20% should be added. 23,625. So therefore, in order to take up this decommissioning liability, the total cash flows should be 141,750. Labor cost, allocated overhead equipment cost, plus contractor's markup of 20% of the total cost. It comes to 141,750 based on current prices. But this liability is going to be incurred after 10 years. For that purpose, the inflation factor is given at 4%. So 4% per annum. So what will be the inflation factor after 10 years? It will be 1.04 power 10. Like that, if you do, you will get 1.4802. Compounding, is it not? 1 plus r whole power 1 plus 2 plus 3 plus like that. If you do, we will get it as 1.404802. So that is inflation factor. So at the end of 10 years, the cash flows adjusted for inflation will be 209,818. It's very simple. Multiply 141,750 by 1.4802. That will be. Then in order to take up a market risk premium of 5% is there. That also should be considered. So the total expected cash flows adjusted for the market risk will be 220,309, a liability which may arise at the end of 10 years. But what is its present value? The risk-free rate of 5% plus risk adjusted rate of 3.5%, total 8.5% will be the discount rate with which you have to discount it to present value to get the fair value of the decommissioning liability as of today. So therefore, 2,20,309 multiplied by 1 by 1.085 power 10. That will be the value of 220,309 after 10 years. Present value will be 97,443. So based on the inputs provided by A Limited and based on the other information given in the problem, a market participant would value the decommissioning liability at present value of 97,443. Can say approximately 97,500. So this is the way in which we have to calculate the fair value of decommissioning liability, friends. So hope I made it clear to you. Everything was easy to understand. Of course, the working note is also there, friends, how to determine the labor cost. Again, before we close for the day and this live session, before we would like to close,